What if I told you that building $5,000 a month doesn't start with a big salary, a side hustle, or a lucky break, but with just $25 a week? Most people believe investing only works if you already have money. That belief keeps them stuck forever. In this video, I'm going to show you a realistic, step-by-step path that ordinary people use to turn small, consistent investments into serious monthly income over time. No hype, no shortcuts, just math, discipline, and patience. This isn't theory, it's the same logic long-term investors have followed for decades. And once you understand it, you'll never look at small money the same way again. But first, we need to talk about why most people never get there at all. Most people aren't broke because they don't earn enough. They're broke because they were taught the wrong game. From the start, the focus is always on income. Get a better job, work more hours, chase the next raise. But even people making decent money often feel stuck, living paycheck to paycheck with nothing left at the end of the month. The real issue is that most people are searching for fast results. They jump from one opportunity to another, hoping for a breakthrough, crypto hype, risky trades, or side hustles that burn them out. When results don't show up quickly, they quit. What they never realize is that wealth is rarely built in bursts. It's built quietly, through boring, repeatable actions over long periods of time. This obsession with speed is exactly what keeps people from building passive income. They underestimate small steps and overestimate shortcuts. And that's why the idea of investing just $25 a week sounds pointless to most people, until you understand what consistency and time actually do. Here's the mindset shift most people never make. The power of $25 a week isn't in the amount, it's in the habit it creates. People dismiss small investments because they're thinking in snapshots, not in timelines. They look at $25 and compare it to today's bills, today's expenses, today's problems. And by itself, $25 doesn't look impressive. But investing isn't about 1 week, it's about stacking weeks on top of each other. $25 a week becomes a system that forces you to pay yourself first. Over a year, that's $1,300 invested. Over 10 years, it's $13,000 before growth. And once returns into the picture, the numbers start to bend in your favor. More importantly, $25 removes the biggest excuse: I don't make enough to invest. Almost anyone can find $25 a week by cutting one unnecessary expense. When the amount is small, consistency becomes easier, and when consistency becomes easy, investing stops feeling risky or overwhelming. That's when real progress begins, and it opens the door to the strategy wealthy investors rely on next. Once the habit is in place, the next step is understanding how smart money actually invests. Wealthy investors don't wait for motivation or the perfect moment. They rely on systems. This is where micro-investing comes in. Instead of making big emotional decisions, they commit to small, automatic investments that happen no matter what the market is doing. Micro-investing removes psychology from the equation. You're not asking yourself whether today is a good day to invest. The investment simply happens. Week after week, money goes to work quietly in the background. Over time, this approach smooths out market volatility and eliminates the fear of buying at the wrong time. Automation is what makes this powerful. When investments are automatic, consistency becomes inevitable. You stop reacting to headlines and start building ownership. This is why people with far less income than you sometimes end up far wealthier. They focus on repeatable processes, not dramatic moves. At this point, the question is no longer whether $25 a week can work. The real question becomes where that money should go, because choosing the right vehicles is what allows small amounts to scale into something meaningful. When you're starting with small, consistent amounts, simplicity matters more than sophistication. The goal isn't to beat the market, it's to grow with it. That's why broad, scalable assets work best for this strategy. Exchange-traded funds, or ETFs, are a common foundation because they give you instant diversification. With one purchase, you own small pieces of hundreds of companies instead of betting on a single winner. Growth-focused funds are especially powerful early on. They prioritize long-term appreciation rather than short-term income, which allows your capital to compound faster. Some investors also include high-quality companies with long histories of profitability and steady dividends. The key is not chasing excitement, but choosing assets that can survive decades, not months. Another advantage of these vehicles is accessibility. Most platforms allow fractional shares, meaning your $25 goes to work immediately instead of sitting on the sidelines. Over time, this creates a portfolio that grows steadily even when markets are volatile. At this stage, the exact ticker symbol matters far less than the behavior you're building. Once the money is consistently invested in the right kind of assets, the real magic starts to show up, not from what you buy, but from what happens when time and compounding begin working together. This is where the strategy stops feeling abstract and starts becoming real. Compound interest is often explained as earning interest on your interest, but that definition doesn't capture its true power. What really matters is that every dollar you invest begins producing future dollars, and then those future dollars do the same. Let's keep it realistic. If you invest $25 a week, that's about $108 a month. Over 1 year, you've invested roughly $1,300. That number alone doesn't change lives, but now add time. If those weekly investments earn an average annual return of around 8 to 10%, which aligns with long-term market history, something interesting happens. After 10 years, your total is no longer just what you put in. Growth starts contributing a meaningful portion. By year 20, the curve steepens. The money you invested early is now doing more work than your new contributions. And by year 30, the majority of your portfolio's value comes from compounding, not effort. This is why starting small but early beats starting big but late. At this point, it becomes clear that protecting and accelerating this growth matters, and that leads to a rule most beginners ignore, one that can either double your results or quietly destroy them. One of the fastest ways to sabotage long-term growth is pulling money out too early. In the beginning, your portfolio is fragile. Every dollar matters because it hasn't had time to multiply yet. When you withdraw gains early, you're not just taking money, you're removing future growth that money would have created. Reinvesting everything in the early years is what turns slow progress into acceleration. Dividends, distributions, and small gains should go straight back into the system. This creates a compounding loop where each cycle builds on the last. The difference between reinvesting and cashing out may seem small at first, but over decades it can mean hundreds of thousands of dollars. This phase requires patience because the rewards aren't immediately visible. It can feel like nothing is happening, but behind the scenes, your foundation is strengthening. Think of it like planting a tree. The first years are about roots, not fruit. Once that foundation is solid and the portfolio reaches a meaningful size, the strategy shifts. Instead of focusing purely on growth, you can begin converting that momentum into something tangible, consistent monthly income. This is the phase most people care about the most, and also the phase they misunderstand. Reaching $5,000 a month isn't about suddenly finding a magical investment. It's about timing the transition correctly. First, you build the engine. Only then do you start drawing power from it. After years of consistent investment and reinvestment, your portfolio reaches a size where it can generate income without shrinking. This is when the focus gradually shifts from pure growth to cash flow. Instead of reinvesting every dollar, a portion of the returns is redirected into income-producing assets or structured to pay out regularly. Dividends, interest, and distributions begin replacing contributions. The key idea is sustainability. A $5,000 monthly income doesn't come from draining your portfolio. It comes from owning enough productive assets that generate cash naturally. At this stage, the weekly $25 is no longer the main driver. Your capital is doing the heavy lifting. This transition doesn't happen overnight, and it shouldn't. Moving too early reduces long-term income potential. Moving too late delays freedom. The balance comes from understanding your numbers and respecting the process. Once you see how this shift works, another truth becomes obvious. The most valuable asset in this entire strategy wasn't money at all. It was time. And how early you start using it makes a bigger difference than most people ever realize. Imagine two people. One starts investing early with small amounts, the other waits, planning to invest more later when life feels more stable. On paper, the second person looks smarter. In reality, the first almost always wins. That's because time does something money alone cannot replicate. When you start early, your investments compound longer. Each dollar gets more chances to grow, reinvest, and multiply. Someone who waits 10 years often has to invest dramatically more just to catch up, and many never do. The delay becomes an invisible cost, quietly working against them. This is why increasing income later doesn't automatically fix missed opportunities. Higher contributions help, but they can't fully replace lost time. Starting with $25 a week today creates momentum that no future raise can buy back. The most dangerous belief is thinking you'll start soon. Soon turns into years. Years turn into regret. Progress doesn't come from perfect conditions. It comes from action. And yet, even people who understand this still manage to fail, not because the math doesn't work, but because certain behaviors quietly sabotage the plan before time has a chance to do its job. The strategy itself is simple, but human behavior makes it difficult. One of the biggest mistakes is reacting emotionally to market drops. When prices fall, many people panic and sell, locking in losses and breaking the compounding process. Ironically, downturns are often when long-term investors benefit the most. Another common error is constantly changing strategies. Jumping from one investment idea to another feels productive, but it usually leads to inconsistency. Every reset restarts the clock on compounding. The real damage isn't one bad decision, it's never staying in one plan long enough for it to work. Some people also try to speed things up by taking unnecessary risks. They chase trends, gamble on hype, or overestimate their ability to time the market. When it fails, confidence disappears and investing stops altogether. Finally, many quit simply because progress feels slow. Early results are boring by design. Growth accelerates later, not at the beginning. Those who give up early never reach the phase where patience gets rewarded. Avoiding these mistakes doesn't require intelligence or luck, just discipline. And once discipline is in place, the entire plan becomes clear and surprisingly straightforward. All that's left is putting it together in a simple, repeatable way. At its core, this entire strategy can be reduced to a few repeatable actions. First, commit to investing $25 every week, no matter how small it feels. The amount matters less than the habit. Next, automate those investments so consistency doesn't depend on motivation or mood. When investing becomes automatic, progress becomes unavoidable. Then focus on long-term assets that scale with time rather than short-term excitement. As returns begin to appear, reinvest everything in the early years to accelerate growth. This is the phase where patience pays its highest returns. Over time, gradually increase your contributions as income grows without changing the system itself. Eventually, once the portfolio is large enough, transition from full reinvestment to structured income. This is how growth turns into cash flow without destroying the foundation you built. Nothing here relies on timing, luck, or special knowledge. It's a system designed to work quietly in the background while life happens. And when followed long enough, it leads to one inevitable outcome: financial independence built step by step, not overnight. If there's one thing to remember, it's this: financial freedom rarely comes from dramatic decisions. It comes from small actions repeated consistently over time. The $25 a week isn't about money, it's about choosing your future over short-term comfort. Every week you delay is a week your money could have been working for you. You don't need perfect conditions to start. You don't need more income, better timing, or special skills. You just need a decision. Once that decision is made, the system does the rest. Progress may feel slow at first, but momentum is building even when you can't see it. If this video helped you understand what's possible with consistency and patience, make sure to like it, subscribe to the channel, and share it with someone who needs to hear this message. And leave a comment below. Would you be willing to invest $25 a week starting now? Remember, wealth isn't built in leaps, it's built in steps. And the first step is always the hardest, but it's also the one that changes everything.